Welcome to Leaders in Lending. I'm joined live and in person today by Angela Conti from USAA and James Morgan from Capital One. Thank you guys for taking some time out of what I understand is a very busy day to come and talk with us.
Thank you.
Well, thanks for having us.
Yeah, this is going to be fun because we're usually a lending podcast, and today we're going to talk about deposits, maybe the most boring banking, most traditional banking product of all time. And so, but just I'm going to start with this question: what's the deal with deposits? What's going on in the space of deposits?
It's been a pretty boring couple of weeks. Deposits are kind of all the talk these days.
Yeah.
So, I think it was a pretty interesting time, maybe kind of pre-SVB turbulence and things like that. But it's been an interesting time, mostly kind of coming out of the pandemic, entering into inflation, talks of potential recessions. And so there's a lot of predicting where the world's going to go. What does that mean? How does it impact different segments differently, different banks differently? And so it's just an interesting time to be studying the problem.
Yeah, I mean, I completely agree. And I feel like the deposit space was one of significant stability for a long time. The pandemic hit and there was a dramatic change, right, in consumer behaviors, in how their money was flowing in and where they chose to store their funds, how they transacted. And as we're coming out on the other end, there are a lot of things that persist and a lot of things that change, right? So it's a very exciting time to be in deposits for sure.
I won't say ignore. We can get into the SVB and kind of what's happened, but I feel like that's more of a short-term thing, although I do think there's some long-term lessons to take away. But talk about what were the major trends as we went into the pandemic? Because I think particularly post the stimulus being introduced, all of a sudden there was like a lot of money. The personal savings rate hit some obscenely high number that it's never hit. I mean, you look at that graph and it's got this one like little thing that looks like an error. I mean, if you saw that in a statistics class, they go, where's the data point that was erroneously entered? And you go, oh, these couple of months were really wrong. But what, from a segment's point of view or a product's point of view, what was really happening there? And then what's happened on the tail end is we've seen the end of stimulus, the savings rate go back down to normal or below normal. What's kind of been the trend between consumers and products or segments and products and deposits post the pandemic? Not that we're post, but post the stimulus, at least I'll say.
Yeah, I mean, I could start. There were a lot of changes underway. And when the pandemic hit, right, many were flush with cash, right? And there was, we were in a very incredibly low rate environment. And so the concept of what are you going to do with that money? We did see savings rates increase. We also saw balances in checking accounts because arguably there wasn't all that much difference between whether you had it in a checking account or a savings account. And folks, as the world opened up, there was pent-up demand, right? And we saw spending start increasing. We were in good economic times. And now, as we reflect on where we are today, we see continued spending, and we also see movement in the balances, right, that we've been talking about quite a bit recently. So I think that pandemic was kind of that seismic change. There's certain things about consumer behaviors that are persisting. So the move to digital is one of those silver linings in all of this. Folks
seems to be more stable than some people had feared.
But a lot of change for sure.
Yeah, I would echo all of that. I think the initial pandemic surge was comprised of a number of factors, right? Like you had the stimulus part, but you also had just staying home, not going on vacation,
less spending,
fewer haircuts and dry cleaning.
Now we've got the revenge spending, the kind of like
a little bit. And I think there was always a mentality of what goes up must come down. We didn't do anything to earn that surge, right?
Yep.
And so there's kind of an implicit assumption that would eventually normalize itself. That took a lot longer than normal, and so you did end up with like finally back to this revenge spending thing. Coupled with inflation has kind of made some of these things happen faster. So I think the dynamics of the initial surge saw, at least for consumers, a disproportionate amount going to primary checking accounts. And so banks that played heavily in that saw a little bit more surge than others. Some of your online direct savings players, not so much. And so you're starting to see some of those things start to flip as we come out of that.
One of the things that was interesting to me is we've seen, post SVB, but I don't think entirely, we've seen, what my CFO tells me is the first time in history we've seen decline in deposit balances in history as far as he can see the numbers. That's interesting to me, the outflow, but also the sense that there is the ease of the fluidity of movement between institutions seems to be much high. I mean, SVB experienced 25% of deposits coming out in a day, which I think, you can have a discussion about the risk management practices they had, but at the end of the day, like, there aren't many banks that are prepared for 25% of their deposits to vanish. It's a pretty traditional run on the bank that would hit any institution. And it makes me wonder, how much are we seeing increased competitiveness in terms of sensitivity to rates? Consumers going, hey, I can actually, there's this online account and I can go get 4 or 5 points on an account that used to never even think about interest on your checking account. Like, I got 0.08 or whatever. And I went, oh, it's like a little bonus, but I was never picking an account over that. And I feel like there's maybe a shift to where there's a little more competitiveness. So I'm curious, is that something you're seeing around competitiveness for rates? And what are the other dimensions upon which people think about the value of an account in one institution versus another? What other kinds of value are there in those accounts? Often we just think of it as like, it's just a checking. It's just like kind of just a thing that you don't think of as having very much differentiation.
Yeah. I think a lot of it has to do with the cycle. I mean, I think the premise of your question started with SVB, but I would go before that. Really, even if you think about the last rising rate cycle, Fed rates peaked at 2.5%.
We're past that now.
So, I think that's just a function of the dynamic extremes of the rate cycles themselves. So where this particular time, now you're pushing 5%, at 5%, and it starts to make things like CDs interesting again, particularly if equity markets aren't performing the way they need to be. And a lot of the things competing for your deposit dollar have kind of fallen away. If you go back a year or two, like the retail investing boom with Robinhood, a lot of people got burned, kind of came back from that. You look at crypto and kind of what's happened there. I admittedly was staking some of my bonus into a stable coin thing at 9% for fun, a year ago. No one's talking about that today, right? And so, it was I-bonds, it was the kind of the biggest game in town over the past 6 months for really risk-adjusted returns.
Yep.
And now those are coming back down to earth as well. And so now we've seen CD demand in the way that we haven't seen in years, which is really pretty interesting.
Yeah, I mean, I would say I think it varies quite a bit based on who that target consumer is or that end customer, right? Because if it's someone who has a lot of money or a business, right, there may be quite a bit of rate sensitivity therein if it's at their discretion to easily move. And we have and continue to make it easy to move money, right? As an industry, which is a great thing. But if you think about someone who is living day to day, like maybe in that more mass market, the other elements around how you bank and who you trust, right? Like, if you've got a sense of safety and security, is there convenience in that account? You've got other elements set up. You might have your bills automatically deducted from that account. You might have other relationships. Those elements matter as well, right? It's not just rate. Rate matters too, but to varying degrees. So I'd say what we've seen, because you did touch on, the SVB aspect, what we've seen has been quite a significant impact, especially in the commercial space, but in consumer retail deposits, really quite a bit of stability, right? In the wake of all that tumult in the industry at large.
Is your sense that the massive shift in the larger, particularly the commercial accounts, that's happened in the wake of SVB? Is that like a temporary, like, what's going on with the world? We need to find I'm going to come back to my local bank or where I was at before. I mean, I got a call. This was one of the weirdest calls I've ever gotten from a financial advisor. Goes, do you guys need to move your money out of the deposit account? And I say, why? Is it for safety? And I went, well, who moves money out of a deposit account for safety? You usually move it out for yield at the expense of safety. And yet for a moment that felt like not the right trade, which was very weird. But I also feel like in 6 months, you're going to go back and go, yeah, it feels pretty safe again. I'm going to go back and put my money back where it was in terms of how you measure. I don't know how much of that kind of commercial shift is a more structural long-term thing and how much of it is a more short-term reactionary experience.
Well, so I can't claim significant depth of expertise in commercial. I am consumer-only focused. However, that segment has long been regarded as rate sensitive, right? Like it's so in the information and the analysis that we have done, it very much looks like a duration, like a matching issue, right? Not a fundamental difference in the depositor's behavior, but rather kind of a mismanagement around how you think about matching duration. So just a fundamental banking mismatch is what I would say, which is why I think that trust factor and trusting the management to know how to understand the consumer or the end customer's behaviors and ensure that the strategies are appropriately matched is important.
My first comment is I would probably rephrase your advisor and say, do you need to spread money around as opposed to take money out of the bank?
I maybe didn't say exactly like that, but the concept is right.
I do think the broader thing that I wonder about is the nature of concentration. I think that can be a consumer or a commercial aspect, particularly with so many banks in America. They're all fighting for differentiation in some different way, right?
Yep.
That was theirs. I think in the end, you have to do that responsibly. And I think I do think it is a great wake-up call for kind of traditional boring banking that's done really well. Borrow short, lend long, hedge your risks. like there is a value add that's there, and I think it's a stark reminder. FDIC is pretty boring. The interesting thing over the past few weeks has been FDIC has been interesting to older mass affluent clients who know all about it and are looking to maximize it. And then for younger customers, just learning about it, just understanding what it is. It's now on their radar.
I think for many of the younger consumers, the idea that your deposit isn't just sitting in cash in the bank, but is actually kind of lent to the bank and they're doing things with it is almost a wake up call going, what do you mean it's not sitting there? That's not how it works. There's a risk that they can lose my deposit. I didn't understand that was true, which is, obviously not under the FDIC cap, but the idea that it could be lost and the government would need to ensure said loss is kind of a wake up call to, I think, a lot of consumers who just had no idea that was a thing. It's been a long time since we had to do that.
I think if my mom didn't make me watch It's a Wonderful Life, I don't know if I would know. Before I worked for a bank anyway. Maybe that's how you learn about it. If kids aren't watching that again anymore, they don't know.
I don't think they're watching that anymore. I think that one's, occasionally, I've shown my kids, but I'm not sure that it's a common watch for the average teenager these days. So you talked about one of the kind of maybe more durable, lasting changes being the digital acquisition. What do you see as the next thing coming in the digital acquisition? And if that becomes a front on to your point, the war for differentiation, what is it that people should be thinking about when it comes to digital acquisition, digital account opening, and the kind of thing that fast follows after it, which is a fraud, and how we think about reducing the friction and making an experience that we like, but not also introducing a lot of risk of, malfeasance.
Yeah.
Yeah, I would say that digital acquisition has to be easy, right?
Yeah.
And so it's on us to figure out how to prevent the fraud, how to mitigate the fraud. And luckily in our ecosystem, there is a ton of data, right? And so those of us who are in the industry, it's on us to make sure that we can set that up for success. And so I think the core of the drive to digital and that persistence is consumers and customers at large have seen the benefit of convenience. They've seen the benefit of how they interact in digital spaces. And for us to continue to drive that, we've got to make sure that that value exchange is very clear, that they clearly see benefit, that they don't feel as if we're trying to tell them, hey, you want to do this, but instead you should do this.
Over here, yeah.
We really need to integrate ourselves in a way that makes it apparent to them how it's easier, how it's more convenient, how it is safe, and really see that through.
Totally agree. I think, post-pandemic, you're really looking at a world that has a higher demand of digital fluidity and ease of service. And Capital One's been on that journey for a long time, whole 5-minute account opening, all that kind of fun stuff. You bring up the right part. The dirty underbelly of that is we're also protecting from fraud at the same time.
Yeah.
And that may just be what's next because, very often fraud defenses are hand in hand with, friction for good customers. And so there's always this kind of push and pull dichotomy of creating friction for good customers is kind of how you defend or have better defense rates against fraud, right? Or, the opposite can be true. I make it easy and fluid and way too exposed to fraudsters. And so, it is going to be a battle for data and capability on doing that well, minimizing false positives, that kind of thing.
The balancing of those two things is really hard. We find it even harder in lending to the extent that when you put friction in front of good customers, you end up driving away the goods. You end up actually negatively, not just losing the accounts, but negatively affecting your credit performance, because like the best customers won't sit through the friction. So then not only did I not get the balance, but I negatively impacted my credit performance by putting the friction there. But it's like, I can have a no friction process. It reminds me of our CEOs sometimes saying, it's the lending business is the easiest business in history to grow. It's just hard to get your money back.
Exactly.
But there is room for hope, right? I mean, where, like, even in lending, like when you think about how far we've come in terms of instant decisioning, right? Like all of that data is out there, and as banking becomes more and more real time, it's an exciting challenge. It's one that we're up for the challenge for sure. Yeah,
I feel like we're just at the early stages of getting really good at these things, and particularly machine learning AI models. Now we have to go into ChatGPT, but the things that it is doing. Even we spent a lot of time in the AI space. We've got a lot of AI models. And when I looked at it, I went, are they doing something we're not thinking about? Because the leapfrog in terms of capabilities is so large. You go, man, when we start applying these technologies in the right ways, can we get really good at these things? And I think there's a lot of opportunity there, but I think it will be a competitive space.
That's how boring deposits become exciting.
Oh, they're not boring in the least.
Nothing boring about deposits. I don't know if you guys want to comment on this, but deposits will become, I'll be curious. The stability of deposits, I think, has been come into question. And so, like, if you think about, not that we need to delve into SVB, but I think at the end of the day, making long-term bets that maybe are not great, right, in terms of interest rate risk, they still aren't bad loans. Like, I had a lot of people come, SVB had a lot of bad loans. They actually bought U.S. Treasuries. Like, they're not bad loans. They're just wrong interest rates, but there's an assumption that I can survive the cycle because my deposits are safe. So I can live through a low return. It just hits my returns a little bit. It's fine. And the idea that your deposits can come and go, like held to maturity is only held to maturity as long as your depositors don't ask for their money back. And the percentage of depositors that might do that, I think we have to now think that that's a more fluctuating number than we maybe thought 5 years ago. And that's going to change risk management and the way you think about the risk of your deposits permanently for, I think, many banks. And that's understanding your risk and your ability to maintain stability in deposits, I think is changing pretty dramatically in terms of how the market thinks about it, and probably how banks will have to start calculating how at risk are my deposits. How do I think about the likelihood of some larger number of deposits coming out the door that causes me to be exposed in some way I wasn't expecting?
Yeah, for sure. I can only speak for Capital One, where we have kind of notoriously conservative risk management practices. So I think
those sound really good right now.
They do. They sound conveniently good right now. But I mean, I do think it's just going back to my statement on classic boring banking and doing that really well. Being risk managers at the core of who we are, whether that's from capital, liquidity, credit risk, you name it. And it floods the organization that way, and it definitely looks like SVB had some gaps in that area.
Yeah, for sure.
Yeah, I mean, I completely agree. I feel like the fundamentals of the business are critically important. You've got to understand them. You've got to appreciate them. You've got to control and watch that data and watch the behavior, right? So that you're not caught off guard or surprised, because understanding what's a core deposit versus a deposit that has likelihood of moving is very, very important. Not every deposit is incredibly rate sensitive, right? People still have money in their operating account, in their checking account. They still have convenience, like even lower dollar savings accounts, right? They might have goals that they're setting up, that they're saving towards. So watching that closely is one of our obligations, right? Is to monitor that and ensure that we're creating the solutions that are meaningful to our target customers.
Are there new points of data or ways you're looking at that in the, not just regarding the pandemic or what happened in SVB, but over the last couple of years of deposits have become interesting and shifted? Are there different ways you're looking at distinguishing between core or more transactional deposits that are more and less at risk, and kind of like thinking about that? 'Cause that's an interesting category of like, how do we understand that, particularly as the nature of what we're trying to measure might be shifting a little bit under our feet?
Yeah. I mean, what I would say to that is, we have more data today than when I started in banking 23 years ago, I could have ever even dreamed imaginable, right? And so the concept of getting down to like the detail of intraday, how things are going, not just at the segment level, but down, like getting really, really granular. I think that's where we're headed, and we've made tremendous progress therein. We've got, certainly more to do in that space. But it is possible, right? Like you need to understand like what is of interest, what is of importance to your target customer, solution against that, and ensure that your strategies are not betting on interest rates, because that is not the job of any banker to do that, but rather that you are thoughtful in how you're managing your book, and you're using your deposit book to enable prudent lending and other ways that you're doing your capital and investments. So I do think there are lots of silver linings in this, and the core, I guess, to your question about stability, the fundamental around primary checking and just that core operating account, right? Like there's not really much that's more important than like, I worked really hard to earn this money. I need a safe and secure and easy
place to put it. Yeah.
Right. Those fundamentals, I think, are going to persist. I don't see that core as becoming overly volatile in the future. I think they're very different segments.
Totally agree. I do think there's an interesting thing where we're talking about the non-rate intangibles of trust, security, whether that's security in all forms, fraud defense, your data. And then we're also always looking at the data to try to figure out if we can analyze and figure out where that is. Right? And really kind of obsessing, what are the indicators of that trust, of loyalty, of deposit resilience, thinking about multi-product relationships, the entire value that you're offering out there. Do you have the tools to help people grow and manage their money? Are you reducing their stress levels based on a servicing experience and things like that? So that's where it becomes really interesting. Like we're using data and analysis to try to get to that kind of core stickiness type of idea. And at the same time, we're chasing something that's a little bit more intangible and earned.
All right. So last question for you guys. What comes next? It's been it's not been a dull last, call it 12, 24 months, but what are your predictions for what comes next in this space and what bankers should be doing to prepare for what's coming? No one likes to make predictions.
I'll start.
It's a scary time to make a prediction. As
I think ahead, I feel like the consumers have spoken. Like they want everything in real time. They want it frictionless. We have, and I feel somewhat repetitive here, but I think that data as a differentiator is going to be critically important, right? We need to work with speed so that we can make it easier for that end consumer. We need to come up with ways that we can provide actionable insights in the moment so that it doesn't feel like work to bank. It ought to be something that's very seamlessly integrated into their lives. And there's been so much advancement in the speed of processing data that I can see that as a reality in our future, and we've made really great progress along that journey. So that's where I think we're headed.
Well, I also feel like there's this thing for not just bank, but any institution saying the presence of so much data. Like we have so much more data, but turning that into actionable insight, that is a thing that is still a struggle. And sometimes I feel now like often for anybody in a large organization, you used to go to the store and there's like two options of something. You want this A or B, and now it's like there's 35 options. I don't know. I just want two.
Just walk out.
I don't know what to do, and I feel like data is that way now, where there's so much. It's harder to extract the insights from the data because there's so much of it, and that's learning how to do that, building the institutional capability, the technical capability to turn data into real knowledge, insights, useful information for your customers, for your own internal stakeholders is like such a critical skill to be building to take advantage of what's coming.
Yeah, to transform the complex into the simple, right?
Yeah.
And there's magic in that.
There's real magic in that.
Problem to solve for sure.
Yeah, I think going back, I think it is kind of that dual mandate of customers' new expectations. Like they don't order food in the same way or paper clips in the same way ever again. And I think about these kind of non-finance expectation setting that's out there around us that says everything's fluid and easy. And then we just talked about protecting your data, protecting you against fraud, and all those things are kind of competing dual mandates. And I think the magic is trying to get that right and get that balance.
Trying to balance the two and deliver the expectations while not falling down on our prudent risk management.
Yeah.
There we go. Well, there we go. Nothing dull about deposits. James, Angela, I appreciate you guys joining me today. This was a fascinating discussion for a guy in the lending space to learn about the deposit space, and I appreciate you sharing your thoughts.
Well, thank you for having us, and we're honored to fuel lending.
That's right. There's no lending without deposits. That is very true.
Very true.
Thank you.